This is a short little video about the Federal Reserve policies to support the global economy during the coronavirus pandemic. And specifically this video will get into the concept of swaps and what the Federal Reserve is hoping to accomplish with its swap operations with central banks from other countries around the world. Now, in order to sort of understand the basics of what the Federal Reserve is trying to do here, you need to understand that an awful lot of the global debt market is in dollars. Basically, this is because the dollar is the reserve currency of the world, and it's basically used in many global financial markets. If you're going to be buying oil, for instance, it's priced in dollars, and a lot of global markets are like that. And for debt markets, dollars are also used as the principal currency. Now, around the world, global investors prefer to lend in dollars because it eliminates the exchange rate risk in global lending. One of the difficult parts of any international investing strategy is the risk that exchange rates do change, and if you're on the losing side of that, you could end up losing quite a bit of what would be a profitable investment. Now, many foreign governments and companies actually choose to borrow in dollars because if they borrow in dollars, they'll be able to borrow at lower interest rates, which is a savings for them. However, the key challenge here is that they also have to repay in dollars, and this is one of the things that the Federal Reserve is trying to deal with right now. Now, in order to kind of understand what we're going to be talking about with Federal Reserve policy, you need to kind of have an understanding of how the global dollar market works, particularly lending in the global dollar market. Typically you could think of international investors as the ones possessing the dollars, and they buy dollar-rated bonds from foreign governments and businesses. Now, when they buy these bonds, they're also buying the risk involved in the repayment of these bonds. And investors, if they're smart, know how to price in that risk. Now, we can think about the dollar market in dollars being based on the exchange rate, right? You have the quantity of lending that's going on, you have the supply side of the market, which are the investors who are lending the dollars, and you have the demand side of the market, which are the governments and companies around the world, which are borrowing dollars. And this gives a value of the dollar, the equilibrium value of the dollar, that could be considered in terms of its relation with other currencies around the world. If the dollar is going up in value, it means that other currencies are going down in value. For this video, I'll just be talking about the dollar, and we'll be ignoring a lot of the other currencies. But I'll be talking about the change of dollar, the value of the dollar, throughout this video. And what I mean is how its value is compared to other currencies. Now, one thing to understand about global borrowing in dollars for debt is that the payments, the interest rate payments, are done in dollars. Now, for many foreign governments and businesses, they collect their revenues, tax revenue, sales revenue, in the local currency, and they have to then exchange that local currency into dollars in order to make their interest payments. Normally, this is not a difficult process if the global market for dollars is stable. However, this is where coronavirus comes in, because the coronavirus pandemic has made investors around the world more risk averse. They see there's a lot more unexpected risk in the world, and they're moving to protect themselves from that risk. And one of the ways to protect themselves is by decreasing the amount of lending that they do in global dollar markets. Now, this decreased lending has reduced the supply of dollars, which, of course, in any market, when you have the supply shift inwards, like you do here in the graph, you have the problem that the price goes up. In this case, the value of the dollar is going up. Now, this puts foreign governments and businesses in a really challenging position, because they're being paid their tax revenue, they're being paid their sales revenue in the local currency, but they have their debt payments that they need to make in dollars. When the value of the dollar goes up, like it did in response to the coronavirus pandemic, that makes the exchange rate more expensive. it makes it harder or more expensive for the foreign governments and businesses to get the dollars that they need to pay off their debts. And this creates the risk of debt default. If they're not able to get the dollars, or they can't afford to get the dollars that they need, then they'll default on their bonds, and that could set off a sort of a cascading wave of problems through financial markets. There's a real interest in the Federal Reserve to support these global governments and businesses simply to protect financial markets. And if you've seen any of the other videos that I've made about the coronavirus economic situation, the Federal Reserve is doing an awful lot to just try and bring stability to markets. So this is one of the reasons why the Federal Reserve is acting here. Now, typically, a foreign business or a government could turn to the central bank in that country for assistance. Foreign central banks do have dollar reserves that they have that they can lend out. And as the diagram would indicates, foreign governments and businesses could use their own local currency, what they have in revenue through taxes or sales, and they could exchange that through the foreign central bank, get the dollars that they need to make their interest payments to repay their dollar-denominated bonds. The problem for foreign central banks is they only have a limited amount of dollars that they can draw on. They only have the dollars that they themselves possess. They can't make more dollars. Only the Federal Reserve can do that. And that's where these swap operations come in, as a way of supporting foreign central banks in supporting their own economies. Basically, the way a Federal Reserve swap operation works is the Federal Reserve swaps dollars for the currencies of that other country. And these swaps are for a set period of time. They basically exchange a set number of dollars for a set amount of foreign currency for a set period of time. And at the end of that time, the foreign central bank will return the dollars that it borrowed, and the Federal Reserve will return the local currency, the foreign currency that it has from that country, to that country's central bank. So there really is no cost here to the Federal Reserve, especially if you keep in mind that the Federal Reserve can create dollars anytime it wants. That is part of its power that it has, is that it is unique in that it can create dollars as part of its policy. So what the Federal Reserve in essence is doing is it is creating dollars that it then lends to foreign central banks for local currencies. Keep in mind, these foreign central banks can make all the local currency they want, just the way the Federal Reserve can make all the dollars that it wants. So they do the swap. That then gives the foreign central bank plenty of dollar reserves so that it can basically exchange the local currency of foreign businesses and foreign governments into dollars so that they can make their interest payments, and then they can make their regular payments for their dollar-denominated bonds. Now, two things to note about the importance here. One is that simply the action of the Federal Reserve to do this removes pressure from the global dollar demand market. Suddenly, international investors understand that the Federal Reserve is backing up these countries, so they'll probably be able to get the dollars that they need. It gives investors more confidence that these foreign governments and businesses will be able to pay off their dollar-denominated bonds. This Federal Reserve action lowers the value of the dollar in global currency markets, which brings a certain amount of stability to these foreign currency exchange markets. And a final thing to note is when the Federal Reserve and the foreign central bank makes a swap arrangement, yes, they make it for a set period of time. The challenge that they have right now is no one really knows how long this crisis will go on for. Basically, we're relying on public health experts to try to figure out how long the United States economy will shut down, and the same is true around the world with lots of other countries' economies. Now, not knowing the amount of time that this pandemic will be carrying on for makes it hard to arrange some of the terms of trade in terms of the length that these swaps will go on for. But keep in mind that these swaps are contracts. When it comes to the end of one swap arrangement, the Federal Reserve and the Foreign Central Bank can quite simply agree to extend the swap as long as necessary. And given the fact that these swap arrangements are basically of low cost to the Foreign Central Bank and the Federal Reserve because they can make the currencies involved, they will choose to extend these as long as necessary in the current circumstance. The general view is whatever policy problems that might be created of this will be less than the economic carnage created in global markets, global debt markets, global currency markets, and also in terms of the economies around the world. So that is the end of this video. Stay healthy.